I think you face a trade-off between a regulation that's very strict and then just sort of that will make the market for sustainable investment products very small versus a label that's kind of loose or some rules that are loose, and then you have a bigger market. So if you think about what is sort of the optimum, that is actually not that easy to say. I think a smart approach has been chosen in the UK, where they've decided to have different classes that sort of map to the motivations that I've mentioned earlier.
Das ist der HSG Student Podcast. Mein Name ist Olli und zusammen gehen wir auf die Suche nach spannenden Geschichten und Persönlichkeiten von der HSG. I assume we, all in one form or the other, have heard of sustainable finance in the last years. According to the Global Sustainable Investment Review in 2023, $30.3 trillion were invested in sustainable assets. And this correlates to 1/3 of the world's asset under management. So really a significant bunch of money is in sustainable investments. But what is actually sustainable investing? How does it relate to the buzzwords of ESG ratings, and does it make actually a difference to achieve the promises that are made that include contributing to mitigating climate change and creating socially more desirable outcomes? Are we only at the forefront of an age and domination of sustainable finance, or are we already in a time where Milton Friedman's famous quote that the sole social responsibility of business is to create profit is over? These are obviously very big questions. Let's see how many questions we can tackle in today's episode of Campus Conversations. But what is sure is that I'm very happy to discuss these questions with another esteemed guest in our Professor series, introducing backgrounds, motivations, and expertise of our faculty members at the University of St. Gallen. And this esteemed guest that is sitting right across me is Professor Julian Kölbel. Hi, Julian.
Hi, Olivier. It's a pleasure to be on your show. Thank you very much.
To introduce you real quick, you are an assistant professor at the Center for Financial Innovation at the School of Finance, also a research affiliate at MIT's the Sloan School of Business. You're also a member of the investment committee at the Stiftung Abendrot, which is a pension fund that is managing the pensions of 15,000 people, amounting to roughly 2.8 billion Swiss francs at the end of 2023 in Switzerland. And you have a background from ETH, in environmental sciences, and from the University of Oxford in water science policy and management. And that there's many other things that I now did not mention, but probably these are the most important if I consider your LinkedIn.
They're all correct. That's all good. Thank you, Olivier.
So I read the big question that you try to solve with your research, and I'd like to jump into it, is whether and how preferences, values, and beliefs for sustainability have an impact on decisions in the real economy. And you also obviously have published in very much related areas covering ESG ratings and standards. But to answer that big question, you have been working and leading on creating the Investor Impact Lab, for which research you also have won a grant. And besides that, of course, also more awards for your research. But I'm curious, as an opening to this podcast, where do we stand in that big question?
Oh, I think we stand very much in the open. That's why it is a research question. And I really like it as a question. So, we had one review paper titled, "Can Sustainable Investing Save the World?" Or sort of just this big question, the idea of investing sustainably, does it really help us in solving problems? I think it's one of these questions that's easy to ask and hard to answer. So where do we stand? I think there are certain mechanisms and aspects that I'm quite hopeful that they're having a positive impact. And then there's a big range of other things that I'm less convinced. And then there's also yet instruments that just haven't been explored fully and we just don't know.
So if you had to give an overview to someone who has never heard about the project, how would you describe, the approach that you choose to solve this big question? Is there like a big master plan behind, or you just start with some question and hope that you get to the other stages ahead from that first question?
So I start from individual preferences. I think the whole phenomenon of sustainable finance is ultimately rooted in individuals saying, me, I have a richer set of preferences than just return and risk. So there's more than that I care about in making investment decisions. So it starts from that. So the question is that true? And how are these preferences? What are they really? Is it one dimension? Is it several dimension? How are they expressed? Are they stable? Or, do they really affect decisions in some sort of meaningful and useful way? So that's kind of where this starts. But I think the whole idea is grounded in consumer sovereignty, right? So this is not something that the government does. It's something that people do out of their own motivation and based on their own values. So that's the first building block. And then, you invest, how do you invest? Usually in products, in funds and so on. And then there's this whole value chain. How are these products structured? There are ESG ratings that select which titles get selected into portfolios and so forth. There's a bunch of questions around that. How do you measure all these things? How do you integrate it with the other constraints that you have? And then ultimately what we'd want to see, of course, is that in the real economy, whether these moral values carry through all the way to a manager saying, well, doing research on this drug is, not, I'm not convinced that's the very best thing we can do for the bottom line, but we're going to save a bunch of people's lives. So let's do it anyways. So I think, whether that happens at the very other end of the chain, that is the big question.
And do you expect to answer this question, let's say, in your time as a professor, or how do you see your role in this whole game of trying to debunk how this flow of moral values throughout the whole value chain goes?
Yeah, I don't know. I'm working on it, and certainly I don't want to claim that I'm the only one working on it. I think it's in research, but generally in figuring things out, it's very important to be aware of other things that have already been done, other colleagues that do similar and related things. And so I think if it was just me, I would be very skeptical of having, a good answer to that big question. But as a community of interested people, I think we can really make strides in understanding it better, at least.
So you mentioned we're standing at the beginning of, let's say, rigorous research in sustainable finance, of understanding the whole individual preferences and processes until we at the end of each value chain. I think this opens actually many topics for our podcast today. I thought about splitting it in kind of two halves. One part where we talk kind of the macro perspective, what is going on, and what is sustainable investing. So to introduce that to our community that is listening, tuning in to our podcast. And the other part where we discuss about more of a micro perspective. Particularly interesting, I think, in that context is your role at Stiftung Abendrot as a member of the investment committee, where you actually have to take these decisions and where you actually have to factor in not only your own individual values and moral preferences, but also that of the people that give you the money to invest as a pension fund.
Ideally, exclusively their preferences.
Or even exclusively their preferences, right? So I think, and then, alongside we can factor in some questions about your person, your career. Is that something that you would agree on? How we move on for the next couple minutes?
That sounds great.
Wonderful. So let's jump into the macro perspective. I mentioned in the beginning, 35 trillion assets under management. That's a huge number. I cannot actually imagine what it means. 1/3 of all assets under management, I read, are invested, let's say, in something that we call, or that is related to sustainability. More than 1,000 financial institutes that manage $100 trillion have kind of signed a United Nations paper that is describing the principles of responsible investing. So to open up, can we say sustainable investing has reached mainstream?
Yeah, I think we can. So this idea, it kind of got big. It's old, right? This started 100 years ago. But since 2006, the Principles for Responsible Investing of the UN, the PRI, exists, and ever since it has become pretty mainstream, I would say. As you've said, there's, the majority of asset managers, certainly in terms of assets under management, have signed up to this. But there's always this trade-off, and you see that between making an idea mainstream and also watering it down in the process. So I think in these impressive numbers that you've cited, $35 trillion asset under management, it's very impressive, right? That's a huge number. But I think it's also worth highlighting that how different are these 35 trillion from the other trillions on the margin, right? Often that will mean, well, the asset manager has signed this set of principles and the principles are good. I mean, they essentially say that within decision-making, we'll consider ESG, so that is environmental, social, and governance consideration, in making investment decisions. But it doesn't change anything about the fundamental motivation, which is to earn a return. And, to the extent to which this information is considered is also left completely open. So if you apply stricter definitions, the amount of money that's managed sustainably is substantially smaller.
What would that number roughly be? Is it rather in the area of 3 trillion or 13 trillion or 23 trillion?
I don't have, unfortunately, I can't quote a paper right now, but sort of Morningstar, for instance, has a fund label where they say, well, this fund is managed sustainably, and they look at the holdings, like, is actually the portfolio of that fund different from a benchmark portfolio? So that's one way you could look at it. And I would say it's sort of a factor of 10 smaller.
Okay, that's significant. But if we look at the 35 trillion, because from what I understand, there's kind of a spectrum of, and I think you also kind of mentioned it, that there's a spectrum of sustainable investing. So from those who are only interested in return to those that are only interested in impact. If you had to break down these $35 trillion, how do you have a sense of how this distribution is represented in these $35 trillion, and what kind of different elements in this distribution do we have?
That's an interesting question. So unfortunately, I don't have hard numbers on that.
That's
but
fine.
I guess you're asking for my intuition, so I'm happy to provide that. I think if we take that 35 trillion, I would say 90% of that is kind of ESG out of a financial motivation. So that just follows the idea that it is profitable to consider a richer set of information. And it's also in some sense a belief that well-managed companies that are careful about producing negative externalities and so forth. So let me just call them good companies, that they are more profitable in the long run, right? If you believe that, then it just makes sense to sort of consider a wider set of information. And then the 10% are, I think, there's actually two flavors of impact. One is more, I would call it values-based. So there's a significant portion of retail investors mainly, but also institutions. And it's maybe, you see it most clearly when you think that churches were one of the early proponents and also practitioners of sustainable investing, where they said, well, there are certain industries or certain business practices where we're just not interested to invest, and we don't care if it's profitable. We don't want to be associated with that through our investment. So I would call that values-based. And then there's another flavor which is more impact-driven, or sort of, people care about the consequences. So they are more, so for example, you might say, if you're values-based, you might say, oh, I don't want to invest in tobacco companies. But there are still tobacco companies and other people invest in them, and they still sell cigarettes, and those cigarettes still cause lung cancer. We know that. So another group might say, well, we actually want to reduce the occurrence of lung cancer and think about how, what can we do in our investments there? And then, you could say, well, let's not invest in tobacco companies. But then you think like, how does that really reduce the, number of cigarettes sold? And maybe it doesn't. So then, maybe you, maybe you think about other ways how you can actually sort of get towards your goal. That's more sort of the impact motivation. So maybe you'll say, well, this is an example. I don't know if this product exists, but what causes addiction, right? That, there are certain drivers, then you might sort of, okay, how can we prevent kids in developing countries from sort of going down that road? Maybe there are alternatives. Maybe we should invest in soccer clubs. And sort of that's how you you come to a different conclusion at the end. It's a lot harder than just saying, oh, we're not invested in that business.
Okay. So, but still, what I also read is that what we can see is that sustainable investments, the growth of what is considered sustainable investments, has declined over the recent years.
Yes.
One reason for that, from what I understand, is tougher regulations on what is considered a sustainable investment. Is that something you would say is a desirable thing? That once there are more strict rules, we see a decline in the growth of assets that go sustainable, or is that a good or bad thing in general?
I think so. It's true what you say. I think the strong growth rates, they have slowed down. They have even reversed in the US, and I think it's several factors driving that. I think there's a general, saturation. So, many people who are interested now have it. There's also a backlash to some extent that people say, well, we actually are actively against it. That's new. And there's tougher regulation, as you say, and that's correct. The rules, what you can market and brand and call a sustainable product or an impact product, have become tougher. I think in principle, that's a good thing. But it is actually remarkably difficult to write good regulation to achieve that.
Yes.
And I think you face a trade-off between a regulation that's very strict and then just sort of that will make the market for sustainable investment products very small. Versus a label that's kind of loose or some rules that are loose, and then you have a bigger market. So if you think about what is sort of the optimum, that is actually not that easy to say. I think a smart approach has been chosen in the UK, where they've decided to have different classes that sort of map to the motivations that I've mentioned earlier, sort of there's a sort of a values-based, but then you sort of have to clearly say, well, this is not in the portfolio and that cannot be in the portfolio, or it's more an impact, it's an impact product. And then you have to show how that impact, what's the mechanism, how that comes about. You have to sort of disclose that to your clients. And I think that is very helpful indeed.
So what do you think? Do we need like everyone, or do we need to force everyone into, let's say, do sustainable investments? Or is it enough that we have, assuming that forcing does not work, but do we need everyone, or do we need or is it enough to have this, let's say 1/3 or even less if we're more strict in considering what is really sustainable, the 1/3 of people that are, or 1/3 of funds that are in sustainable assets?
Yeah, I think if we are talking about climate change and a transition to a lower carbon economy, we need everyone. We need the whole economy to transition. There's no point in transitioning half the economy and maybe increasing the carbon content in the other half, right? So that is not going to lead us anywhere. So eventually we need everyone. I think there are ways in which you can be a pioneer that drags along others. Anyway, so you were mentioning, should we force people? No, we shouldn't force people. I think my point of view is that, people have values, and I see that there are a lot of people who want to solve these bigger problems, right? They're ready to do something about it, commit their time, commit their resources, and there's many ways, but one of them might be through an investment channel. So if you have money to invest, maybe you want to use that, aside from other things. So what can your role be? How can you sort of move the system through your investments? I think that's a really interesting way to think about it. So there's kind of the big tent approach. I think there are lots of low-hanging fruits that, is often sort of really advanced corporations. They already pick them, but there's still a lot of other companies, who could do a little better here and there.
Could you give one or two examples?
Yeah, sure. So I think one great example is methane capturing in oil and gas production. So that has already also been a big topic at the last climate summit. So methane is this gas
4 times more terrible, or even more.
Yeah, 20 times
20
more
times.
global warming or greenhouse gas potential than CO2. And it just sort of, comes out as a side product during production. So capturing those methane leaks is a big deal. That doesn't mean that oil companies stop being oil companies, but still, at the margin, that's a big impact that could be had. So then, you have laws and rules around that. But if investors say, hey, do that, then that plays an important role. And there are examples where investors have sort of pressured for that. In the case of Sinopec, so that's a Chinese oil company. And the result of that has been a significant reduction of CO2 emissions in oil production. Well, you can kind of see how that is not going to solve the problem, right? That's kind of, it makes a contribution, but that still does nothing to global oil demand, sort of, to the way just economies are run. So it's something on the margin, but it is helpful. And then another route is to think about, well, what is there in terms of technology that would really sort of, rewrite the incentives. So you could, as an investor, if you're able to take some risk, then you can try to help along develop novel technologies that potentially are a game changer. So I think Bill Gates is doing that with his breakthrough energy venture funds, using the wealth that he has to the effect that innovations, basically he wants to sort of make sure all the innovations that are around kind of come to fruition and sort of do their utmost to address the problem. I think that's a good way to think about it.
Let me think about how to follow up on that. I think this goes a bit into the direction of one of the papers that you wrote, I think, because it's about capital allocation and allocating capital to, let's say, if you can, to more risky companies that can do that can create, for instance, technology that is really beneficial for climate change or mitigating climate change. But something that you mentioned that is way more, or there's more evidence in the literature, is shareholder engagement, right?
Well, in a way, these two options that I just described are those two, right? Shareholder engagement, where as a shareholder, you approach the company and say, well, we're invested, we believe in your business model, but I think there's something that you could do better, and it is this, and we want you to look into that. That's shareholder engagement. And that works. So it has been shown to work. For example, in this methane case, but it's also just important to realize that it has its limitations. So this is not going to have this transformational effect in the sense of, if you do engagement with a tobacco company, it's just, I'm not sure how far you get, right? Because maybe there isn't that much that they can actually do. So they can't get out of their skin, right? But sort of, I'm also convinced that any company has a few things that would be really worth doing that don't cost them all that much, but have a big impact on society or the environment. And in fact, that is an important consideration in thinking of what should be the contribution of the private sector in principle to these big problems, right? Because often you can say, well, the government should take care of it. And I agree, but the government also doesn't operate in a vacuum. And we have, 180 governments around the earth, and it's really difficult to coordinate on these issues. You have free rider problems. And that opens up a wedge where you can say, well, it is actually really desirable and optimal if businesses step in. And that's usually the case when the companies have a competitive advantage in tackling the problem. So for example, methane, right, sort of an oil and gas producer, they know how this works. So for them, it's pretty easy to take care of them. It's harder for a government to figure out, well, where does it come out and what to do about it. So there's these situations where it's just really worth for companies to take the lead. So that was a lengthy answer to saying, okay, there's shareholder engagement and capital allocation. So shareholder engagement, you can sort of ask for these things that are within the scope of the business plan, or you could call it the zone of discretion that management has. And ideally, you ask for something where the firm is more effective than the or a government in tackling the issue.
And I think something that is also interesting to me is what I've learned in finance, to come back on the perspective of an investor. Risk equals return. You have to find the optimal return given your risk profile, or you determine the minimal risk you can take given your return expectation. I was interested in hearing your perspective about, is sustainability or ESG something that needs to be factored into these two aspects? Or is ESG a third player in this whole equation that changes how we do finance in the long run?
Good question. I think both is the case. But depending on where you see it, the way to deal with it will be different. If you think that, good ESG practices lead to either lower risk or higher return, and then you don't need sustainable investing because all investors are interested in high return and low risk. Then you can just think, well, what are the reasons why perhaps it doesn't come out at the optimum? There's frictions maybe around information, maybe it's around long and short-term problems that sort of, the effects accrue in the long term, and there's incentives to act in the short term. Maybe you have to remedy that to get more, your more positive outcomes. But if you believe it is actually sort of orthogonal to business success or business risk, well, then you need mechanisms in addition to just, the market, just letting the market play. So, and of course, in reality, I think it's often sort of in between, right? So it is, and that's why, in the reality, it's often in between.
In preparation of this podcast, I watched a video by a New York University Stern professor, Damodaran. Not sure whether you're familiar with him. I'll come back to him when we talk about ESG more precisely. He mentioned that there's, like his conclusion of his 30 minutes lecture roughly was that there's no evidence that you will get rewarded when you're, let's say, a good company. But you will get rewarded if you're not a bad company, because bad companies would face higher financing and capital costs, which is bad for the company. Would you agree to this statement? From what you see in practice?
I agree that it is. So if you deviate from the norm in terms of bad things you do, the punishment for that tends to be harsher. And we're also much better in identifying it. So if you, let's just suppose you are a clothing retailer and it turns out that in one of your factories you have enslaved children working for you. So that is going to be a very salient news story, and it's going to be very uncomfortable for the people involved and responsible for that. And they'd be, and they'll do a lot to get out of that. Whereas if you have a factory where everything is going super well, who's going to notice that? So I think, and also just, you see that the media tends to report on the things that are bad, but that's not because the media is screwed up. It is perhaps, but that's not the reason. It is because we are more interested in bad things. Like, so it grabs our attention if things go wrong. And that's why I think it's a valid statement to say, well, just don't do wrong, or sort of don't do things that are obviously wrong, because, a lot of people will have a problem with that. But I think what's really important is I don't like instrumentalizing the argument in the sense of, you should do good because it'll be more profitable to do good. I think the right attitude is to do it right no matter what.
But isn't the difficulty, and I think in a minute, and I think this connects to the ESG discussion, isn't it difficult isn't it different across, let's say, the whole globe and even within one country, what is considered to do it right? True.
I'm not saying it's easy to know what's right, but I think the motivation should be, just that, to do it right. And then with all the complexity that has, and often you have to balance different things that are right. So it is right to get out the most for your shareholders. It's also right to pay your employees a fair wage and keep them motivated. And it's also right, if you have the choice between two production processes, one of them is super dirty and the other one is very clean, and the super dirty one is just a bit cheaper, then what is the right thing, right? It's hard to say, but that's what it's all about. And I think it's a bit misleading to say, well, if you'll choose the good option, that'll pay off in the long run, because maybe it doesn't sometimes.
I think there is no, or Damodaran, he mentioned there is no evidence kind of on profitability if companies are good, or no, let's say no coherent evidence.
Right, I agree with him, but I can't prove that either.
So let's talk about ESG, because I think this is really also a bit about measuring what is the good thing to do. And I think one way to move, let's say, more financial flows towards more sustainable ways is through ESG, I would assume. The concept of ESG, from what I understand, tries to capture kind of the level of sustainability of companies or funds, if I had to summarize it in one sentence. Can you give a bit of an insight into how this ESG ecosystem works, and what kind of potential other mechanisms exist in guiding, let's say, these financial flows towards more sustainability without forcing the people, as you established before?
Right. Okay, let me unpick that a little bit. Maybe I think what you're saying are ESG ratings, so basically grades for companies, how good they are in sustainability. So I'll talk about that in just a moment. The other term you brought up, which I think is important, is directing financial flows. So that's language that comes out of the Paris Agreement, that we want to direct financial flows. And I think people often just misinterpret that picture. Because what we're ultimately trying to do is sort of, we want to, for example, change the energy production system from one that is predominantly fossil fuel based to something that's more renewables based. So that's infrastructure on the ground, right? So that's what it's financial flows towards, hydropower stations and these kinds of things. That's something very different than financial flows towards companies. Where you are so there's a big difference between capital expenditure of companies and then our investments as investors in companies, and those things tend to get mixed up a little bit.
Thank you for clarifying.
So I just want to sort of point that out. So ESG ratings. ESG stands for environmental social governance. It has become this shorthand for how well are companies doing in terms of not polluting the environment, treating their labor force and communities well, and having solid governance. And it's a bit of a miracle how governance ended up in that mix. So I think corporate governance has been important to investors since ever.
Because of the principal agent problem, right?
Exactly. I mean, yeah, it's just sort of that's a core problem of investing in corporations and how does it all work that you don't get cheated essentially as an investor, right? That's all about corporate governance. So I don't know why that was bunched together. I often think the emphasis and sort of the novelty of ESG ratings, as they're called, was to look into environmental and social issues. But effectively, they mix these three things. So these are institutions, and I like to think of them a little bit in terms of teachers that give grades to their students, being the companies. And so they all have a little bit their own way of how they give these grades. They'll look at different aspects of sustainability. They'll have different weights on maybe the environmental or the social domain. And they also, most of them have their own raw data that they sort of source from a variety of sources, often the corporate reporting, news, governmental entities that provide data. Some of them use satellite data. I mean, they just sort of, combine all these different data sources. And I think the main thing that they provide is convenience, because it takes a lot of time to actually make up your mind how good a corporation is in terms of ESG, because these are big organizations. They do all kinds of things, and it's hard to compare, really. So ESG ratings they offer a service in making that easy. They give you a number, and you can easily rank and list companies according to that number.
And from what I understand, you can use it as, let's say, let me frame it differently. The way of money, how it flows, is basically you're an investor, and you usually invest in an intermediary, and there are sometimes multiple intermediary, like funds of funds, or funds that invest, let's say funds of funds, and then in the end you have the company that receives the money. In the most simple way of describing the flow of money, and on each, let's say, transfer, you have basically the possibility to look at ESG ratings and see how is that company performing, or how is that fund performing in terms of ESG, aggregated by the weights of the fund's allocation of capital.
That's right. I think the main unit of analysis are corporations, but then you can aggregate that up to a portfolio, to a fund, and that it's correct what you say. You could make it really personal, sort of say, well, if you take your money and you go to a bank or an asset manager, and then they'll do something on your behalf, but they might tell you, well, this portfolio, everything is at least rated BB, and things like that, or the carbon intensity of that portfolio is going to be 100 tons per million francs invested, and things like that. So that's all ESG data and ratings, and they're used a lot also in the sales and sort of documentation of investment products.
And I think in a study you did yourself in 2022, I think, you looked at these different rating agencies that provide these ESG ratings. And I think what you found is what you described before. They differ a lot. There's not much correlation. If you look at one corporation, the different rating agencies rate them differently.
Right.
Is one solution to that, or do you want to comment on that first before?
No, so that's correct. That's a good summary of the paper. I just want to comment, because I said earlier it's convenient if an ESG rater gives you a number. But of course, it's a complex evaluation, and the complexity it sort of disappears when you get that single number, but of course it's still there. And you see that because then if you get another rating, it will give you another number. And then you think, well, why? Why are these two numbers different? Didn't I just, go to that one? Well, they look at the same company, and that was the service I wanted, right? I wanted, someone to tll me how sustainable is that company. But, you get two different ratings, and you'll get two different opinions, because that is what they are. And there's a lot of assumptions that go into that process. And that's what we document in that paper, that we took 6 ESG raters at that point, and we saw, well, the correlation is not that they're not correlated. So, a company that's good in one rating tends also to be better in the other rating. But it is, if you sort of look at the data, it's difficult to judge whether a company is sort of top of the league or more in the middle range. Sort of that, if you look at several ratings, you just don't know that.
So do we need, as an alternative, kind of a summarized one perfect or ideal ESG rating? Is that even realistic?
No, I don't think we need one ESG rating. We need 2 things. We need more clarity about what individual ESG ratings are about. And then we need competition between ESG ratings on quality. So when I say clarity about what they are about, one fundamental difference is related to this impact conversation that we had in the beginning. So whether you measure as an ESG rater to what extent ESG things might actually endanger your corporate profits, sort of, if you treat your employees too badly that maybe they will strike and sort of slow down your business. That's one perspective you can take. Well, or you take more sort of the inside-out perspective, and you purely rate, what are the externalities that the firm imposes, good or bad, on the wider economy, without thinking too much whether they'll eventually bounce back, right? So these are very different perspectives, and I think you have to be more clear than which one of those it is that you're measuring, rather than saying, well, that system that we have is great to measure either of those, because that's usually not true, right? They're very different perspectives.
And I think from what I read in the internet, you are advocating for, let me quote, a regulatory and mandatory disclosure regime for a smartly chosen small subset, well measurable set of, let's say, measures on the ESG fronts. So this obviously raises the questions, what kind of measures do you suggest? Do we have an idea? I mean, if you had already the golden bullet or silver bullet, you would already shot it, but do you have some ideas on what this should include, this smartly chosen set of measures?
Yeah, I'm glad you bring that up. So that's actually a third point that we would need beyond clarity and competition. One of the problems that we unearth in our paper is that not only can you sort of disagree on the perspective that you take, but there's actually sort of the underlying data that different raters use is often of private nature. So they've created that themselves. And it is often inconsistent with the data that other raters have. So it's a disagreement about facts, if you will. And that's always bad. And to remedy that, it would be helpful to have that, well-chosen set of disclosure metrics that corporations have to put out, so that at least at that level there's agreement about, what are the facts. Similar to, financial earnings, right? An income statement gives you the fact of what happened in the last quarter or the last year. And then you can, base your projections of what's going to happen or why that is the case on those facts. With ESG, there's voluntary reporting, but the problem with voluntary reporting is you don't know about those that don't report, and those are maybe the most interesting. There are also different standards, and then that makes the whole comparison thing difficult. So a nice solution would be, okay, these are the 20 indicators that companies now have to disclose in addition to their income statement. Or you can argue whether it should be 10 indicators or 30. And of course, which indicators those should be, that is really a tough question. What I see now is that different jurisdictions coming up with, different indicators, different sets. So the European Union has a very expansive set of indicators, and in my view, too many. There's a list with over 1,000 indicators that companies could report. They don't necessarily have to report all those thousands, but they at least have to sort of consider which of those are relevant. I think that's too much. And I hear also companies complaining that that's a bit, it's just
too exaggerated.
It's excessive. And then the US is taking the other approach. They say, well, it's only carbon scope 1 and 2. And even that you don't have to. So I would have wished for some, I think a lot of corporate leaders would have wished for one standard globally applied that's kind of, not perfect, but a step in the right direction, but a consistent step. So that's what we argued for. Unfortunately, I don't see that really happening at the moment. And I don't want to blame people. I understand these are difficult things to get going in the first place and also to get them right. But I would, encourage people involved in this sort of to push for, let's have a set of metrics, and that's something that we can base all the other more sophisticated analyses on.
But is there one or two measures that or indicators that you think they have to be in regardless? Could it be CO2 emissions, scope 1, 2, 3? Or is that too much? Or is that already too much? Or is there anything else that you think that really should be in?
I think the CO2 metrics, they're pretty well developed. There's a protocol around it. Scope 1 and 2 is pretty uncontroversial, I think. Scope 3 is more controversial, and it's actually something that you cannot really measure. It is always an estimate, even for a company, like they can't measure that. Nonetheless, I think that's a pretty helpful number. So I would probably include all those three. And then you'll have some, I think, employee relations, sort of something around wages or wage gaps would be good. I think those would be sort of the absolute fundamental ones, probably.
And you mentioned it's really difficult, and we're not there yet. And you said you don't want to blame anyone, but is one of the reasons, or could one of the reasons be that the existing rating agencies, I think they have been bought by large corporations, large other rating agencies, and financial data providers, and probably also currently, there's some, from what I heard, there's consulting companies. They have like kind of a business in helping their clients to provide these excessive ESG reports where they talk good, not necessarily walk good, not saying that they don't walk good at all, but they mostly talk good. Is that also one of the reasons why we're having difficulties in finding this one standard, or is there another, let's say, elephant in the room?
No, I think that's a good point, that there has been consolidation in the ESG ratings market, and it comes with a number of concerns. One is that whereas many of them started out in Europe, they're now ultimately owned by US companies. And it's just important to acknowledge that ESG is also around political views, and they are different across the Atlantic in some cases. For example, healthcare, right? In the US, you sort of, you could be considered a good corporate citizen if you offer generous healthcare to your employees, whereas in Switzerland and most of Europe, that's kind of ridiculous because you already have healthcare from the government. So no cookie points for companies that do that. But I think the more fundamental concern is that ESG raters usually were started by people with a certain mindset, right? They did that not primarily because they thought they're going to get rich. They thought, this is something important that they cared about, and they put a lot of passion and their morals into it. Right now, once these businesses are sold to, among mostly sort of the big credit raters, so Standard & Poor's and Moody's, what is their motivation, right? And if you kind of think back just a few years, they have pretty low credibility in sort of working for the common good. Just if you think of the financial crisis, right? they they really have to work, I think, to convince us that they're now this time around they actually
mean it.
yeah, they sort of and just the incentive, and that's why I brought up the incentives and how do ESG raters compete. So in some sense, there's a bit of a monopolization in the market happening, and that solves the problem with the divergence, right? You get less divergence if you have just one standard that establishes itself just commercially as dominant. Does that make the problem go away? No, right? Because now you have just one observation or one opinion on this complex matter, rather than what you previously had was a number of opinions. So the confusion sort of disappears, but it's still there.
And I think one additional problem that is associated with ESG is kind of ESG effectiveness. That kind of, does it really work? Because it's kind of, as we discussed, it's kind of difficult to estimate, and does it really make a difference? Isn't it just a dangerous placebo, in the sense of that you give a good feeling to an investor? Hey, you have now this ESG tick-boxed fund. Don't worry, this is good. Can you maybe explain a bit more, or would you say this is an issue as of now?
It's a huge issue. I think is it effective? Does it have impact? That is the question I'm interested in. I think and there's direct effects and indirect effects. So the direct effects of, let's say you decide you'll put your money into an ESG ETF, right? And then that will overweight a few companies. Perhaps Vestas, the turbine producer, will have more weight in your portfolio than it otherwise would have. Now, what does that do to the share price of Vestas? Perhaps it goes up a tiny little bit. I mean, you're a small investor, but maybe if others do that too, right, it goes up a little bit. And then does it ultimately lead to the fact that Vestas sells more wind turbines? It's a long shot, right? And it depends on a lot of things. One essential thing it depends on is how constrained is Vestas in their growth by external financing. So some companies really need external financing, and they would grow more if they had more. Sort of is really fundamental to them. But this effect is likely going to be a lot stronger with startups, right? So for startups, it's often a matter of life or death if they get funding at the right moment at sort of a rate that's acceptable to them. The large listed corporations, they have access to a market, and it's really difficult to sort of change what the market gives them. So I think there's a couple of question marks around the direct effects of ESG investing for sure, and you have to be quite sophisticated about it, how you approach it. But it's also probably wrong to say, well, this doesn't do anything. It's just hard to, as much as it is hard to prove that it does good, it's similarly hard to say, well, actually, it doesn't. And theoretical models will tell you, well, at the margin, it probably should move things in the right direction. And so what comes to the fore, and you mentioned that, is it a dangerous placebo? So does it have indirect effects? And that's potentially very important. Maybe you, after you've invested in your ESG ETF, you're very happy about yourselves, and then there's a political decision in Switzerland, and you actually kind of it's about a climate law, and you kind of want to vote for it, but you're on vacation. You're like, yeah, whatever. I already invested in my ETF. I'm going to fly somewhere anyways because I'm already have done good. So it may be the case that, by taking that one action, you do other things that you otherwise wouldn't have done that are actually bad. So how does that balance out? I think that's a really important question.
And do we have some insights into this important question to date, or is there some that is... I know that you researched about the willingness to pay, and that it is related to more emotional aspects, at least in impact investing. So from if I interpreted it correctly, basically, if you're told it's sustainable, you don't really care about how sustainable it really is. and as long as you know it, or as long as you think it's sustainable, that's fine, even if it's probably not. So it opens this avenue for greenwashing, which is a big topic also in ESG.
Yes, so we actually did run a study on that very question of, is it a dangerous placebo? And we did it in Switzerland because here we often have public referenda where you really sort of everybody gets to vote. So we did that in the context of the vote on the climate law last June, actually. And we had two groups, and one of the groups got to invest in an ESG ETF. And we wanted to see whether those people then dial down their support of the law, right? Whether they make this trade-off between sort of a private investment decision and then sort of a more, oriented towards the public, sort of a political decision. And we find that they don't. So I think that concern that ESG is a dangerous placebo is overblown. I think it's true what you said, that people are kind of emotional about it, or sort of they are not very, that's the wrong way to put it. They are not very careful in sort of calculating the specific impacts they have with this or that decision. But in my view, that comes a little bit with the benefit that people work on heuristics or principles instead, and they are pretty robust. So sort of, if given once the choice between green and not green, depending on where you stand and what your preference is, you might take the green thing, and the next time you're exposed to that decision, you just do it again. So I feel this is a bit of a pet theory, but I feel because people aren't bean counting, they're also kind of, instead they just sort of have a principle and sort of decide the same way each time. And that in the individual decision you say, well, they're a bit limited somehow because they don't really evaluate the option that they're given. But taking it a step back, it's actually kind of a robust approach. So I'm kind of relieved to see that.
And but the other study on the willingness to pay for impact, is that not related to that at all, or is
no,
because
related,
it opened up to this green? It opens this notion to greenwashing because basically corporations can make an effort to sell what they do more emotionally and more sustainably, and that's enough.
So yeah, it's very related. So I think this ties back to my view that this is about personal values, and that's the driver of that all. And I observe there is just a part of the population who wants to do the right thing in their view, and in their view, the right thing is the green thing. And I'm aware that not everybody holds that view. Other people say the right thing is lower taxes, or the right thing is freedom. That's fine. I'm fine with that. But there are people who say, well, the right thing is the green thing. So they have this motivation, and I think that's beautiful. That's around, and that's kind of alive and kicking, and that's all we have in some sense. That there are people who have that motivation. But they don't know what is the right thing. And that's, I understand that's really hard to know what is the best thing you can do, right? You can, but they are pretty good in giving a choice between two things. They can kind of figure out which is the better thing. They don't know whether that's the best thing, but they know, okay, this is the better thing. That's easy. So that's what we observe people doing. So the problem with that is, if you don't know what's the best thing, you may be overpaying for something that just looks a little better than the alternative, but it's not actually the best thing. So that's what we see in that willingness to pay study. So people overpay for kind of a, ridiculously small difference to the standard product. And that can be exploited by providers in some sort of greenwashing fashion. But if they know that people pay more for a product that's essentially the same and just a tad different, well, then you don't really have an incentive to offer a product that's radically different, because that might also entail costs and so forth. So, sort of you go in with this minimum green option to get that extra willingness to pay.
And get away with it.
And then you end up with some sort of light green equilibrium where you have a bunch of, greenwashed financial products. The customers are happy because they get green products. The asset managers are happy because they get extra fees. But of course, the environment is kind of unhappy because nothing has changed. So that's a problem. And to address that problem, I think you're probably going to ask next. I see you nodding, right? So I think that's where the whole idea of ESG ratings and labels comes in again. So because people have a hard time, knowing what is kind of the best product, that's where label really play a very influential role. And we have that in other areas where quality is hard to ascertain. So with, organic products, I mean, how do I know this is an organic apple? It doesn't taste different, right? I don't see it. I don't smell it. So I need a label that's stuck on there that tells me, oh, that's the organic apple. And by the way, it's more expensive. And then I need to trust that label. And underneath that label, there's a bunch of scientific work that sort of really establishes, well, is that really better and which production system and so forth. So I think for financial products, that's, I think, the way to go. We need a label, and that label has to be well designed in the sense that it incentivizes sort of useful, effective products.
And who should bring up this label? Is this the government?
I think the University of St. Gallen should make a label like that. No, I think clever people that have the right incentives should do that. It doesn't have to be the government, I think. It could be a private label. I think you'll end up with the same place. You'll have different labels. How do they compete? A lot of it is transparency. I think academia has a role to play. We're sort of, in a nice position where we can take time to look at the details of these labels. We don't profit from the use of those labels, so we're kind of removed from that. And we can help, convey trust to certain labels. Sort of, if academics endorse and say, yeah, we've looked at it and we think this is really good. So I think that's an important role that academics could play.
Something that I see in my, let's say, when I talk to my friends, not saying that we're talking about big investments, but when, this topic of ESG, it comes up regularly. But what I sense is many people are kind of annoyed by just hearing them, either because they're disappointed or because they're just annoyed because they feel like someone is trying to impose something and restrict their decision or try to notch their decision into some place. Is that something that you observe as well? Is that an issue for the whole sustainable finance discussion? Because it probably has the danger of that we lose people on the way that gonna kind of say, oh, I don't care in the end because it doesn't make a difference.
That's interesting. I think that is to be taken very serious, right? It brings me back to, I think this is something that, if you want to do that, then do it. And if you don't, I'm the last one to force you. That's an individual decision, as investment decisions should be. So I think that's very important. And then the disappointment fact is also important, right? Sort of then it's very disappointing to go into a product and then to later hear, well, what you picked there, that's really greenwashed. Like you shouldn't have done that. Yeah. That's pretty frustrating. So I think that's also a reason why these, just a clear distinction that is, I think, what essentially people want. I mean, in my experience, most people also don't want to really dig into the details. They just kind of want to know, what should I do? I think one way that's more fun, perhaps, you can also segment your investments that you say, well, the bulk of it, I'll just, do something standard. And then, but with some part of it, may that be 5% or 10%, or depending on your appetite there, I do something, where I'm really close, like I, or participate in some crowdfunded startup that I really think they're doing something fantastic. And then you have this, I think that's more fun, honestly, than an ESG ETF, really. So I also sometimes advise people to sort of, do that segmentation and then do something which is perhaps quite risky. So don't overdo it, right? But at least something that you identify with, and then and then that's often a more satisfying option to do sustainable financing, really.
And let me ask you now, if you're willing to share, how do you do it? Do you invest in ESG funds, or do you say, "Oh no, I'm gonna go for the ones where there's, let's say, more additionality, where I fund these crazy projects"? How do you do it, if you're willing to share?
Yeah, sure. I am willing to share. So I do three things essentially. I have chosen a bank that has just a very high ethical standard, because I think that's, the thing that most people have. You definitely have a bank account. In many banks, you have no idea what happens with the money on the other side. So I've chosen a bank that's sort of very explicit about that. They even, upon request, they send you who they lend their money to. And I think that's just
amazing.
Yeah. So I really appreciated that. And many banks, I feel they, try to attract students with some cookie points and discounts here and there. And I don't really, that was the thing that was important to me. The second thing, then, I'm a cost conscious investor, so I've gone for ETFs, but I've chosen to do it with an institution. So the asset manager is very strong on this shareholder engagement. So I think it's important that this happens at the institutional level, not at the fund level. It's kind of ridiculous if an asset manager sort of engages for sustainability with one fund, and then they have another fund, maybe even managed by the same portfolio, and there they don't care, right? That doesn't work. So it has to be at the institutional level. So I've chosen an institution that I kind of believe they are doing this, with good resources and with a lot of knowledge and with a good set of goals. But essentially, they manage this money very cheaply. And there's not many constraints on sort of the capital allocation. And then I have one investment in a water treatment company based out of Singapore. They sort of do decentralized water treatment in schools in Asia. And that was a convertible debt investment. So first I was a creditor, and then they converted that into equity. And there, I don't know if they will ever exit. So I'm not quite sure what's going to happen with that money. It's not a big part of my portfolio, but I'm having a lot of, fun because I partake in the AGM and sort of I see what they're doing. And, that's sort of my impact investment. That's what I do right now. I'm, looking forward to expanding that over the years, but that will take time.
And I think one question to conclude this whole part about ESG, because we now discussed about all of these many, let's say, problems or just difficulties associated with the topic. Is there alternatives that you see on the way besides doing these crazy outside investments? And is a future without ESG possible? Or is ESG going to stay here forever?
You kind of asked three questions at once. So I think ESG is here to stay for two reasons, one good and one bad reason, I think. The bad reason is there's now a lot of regulation around ESG. So it's going to become something more like tax law that is just here, and it'll keep people busy, whether they like it or not to some extent. But the good reason is also it's going to stay because there was a reason why it emerged in the first place, and that's people want it. Not everybody, but enough. And so that's why it's, I think, going to be here to stay. It may change in its shape or form, but it's staying. Do you need these crazy investments, sort of, finding this wastewater treatment company in Singapore? That's kind of a relationship game, right? How do you get there? But I think it's not too, there's some very simple options. I don't personally own a house, but if you own a house, that's probably the biggest investment of your life. And there's a lot of things you can do around your house in making it more efficient. And that's a pretty easy way of doing, people don't call it ESG investing, but that's something very impactful. You're in full control of that one asset, like you're not a minority shareholder. You call the shots, right? And if you say, well, that's too expensive, I'm not going to do that, that's also your prerogative. But I think, people overlook that sometimes, that the easiest thing is just to upgrade your house.
Start with your daily habits, basically.
And your day, I mean, of course, but that's, then that's your consumption. You can also think about your car and, how do you travel and things like that. And that, I think that's worth thinking about, not just the investment channel, but, what are the things that lie within your discretion that you also feel comfortable about debating, making a change. And I fully acknowledge that people have different needs and habits. I think with young people these days, it's often the case that your loved one happens to do an internship in Canada. And then, well, I guess the flight to Canada is something hard to say no to. I recognize that, right? But then there's maybe other things that you can do. So I think it's good taking a step back and thinking, well, what can I do? What am I willing to do? But then also do it.
So, I think this serves as a great transition to the second part of this podcast that is already taking quite a long time, which is nice. So about the micro perspective because the micro perspective, and you have the role as sitting in the investment committee for the foundation Abendrot, which is this pension fund, as mentioned initially. Let me just start over. Maybe it's a dumb question, but what kind of possibilities do you have as a pension fund to invest sustainably?
Well, so the difference between you and me and a pension fund is that you come with a lot more money to the asset managers. So the range of products and the service that you're being offered is quite at a different level. The difficult thing is, you're under a great responsibility. You invest money on behalf of other people who pay in, and they expect to live off that money once they retire. So obviously the fundamental goal of a pension plan is to take care of that money, grow the pot, and make sure they can pay out what is promised to the pensioners. Abendrot has a mandate. So it was founded in 1984 with a set of core values and right off the bat, a couple of exclusions. So it's in the rules, basically, that we cannot invest in fossil fuel companies, for example. And then, of course, people in Switzerland, your employer chooses which is your pension fund. So that's kind of an interesting relationship. So it's not an individual choice, really. It's employers who said, okay, this is a nice pension fund, let's insure there. I hope that they, in every case, involve their employees in that decision. Anyways, we are always happy to be in touch with the ones that are insured. But the point I'm making is we have a mandate to consider the Abendrot values in the decisions that we then take. We came up and we thought, okay, how can we have on the one hand these exclusions that, we just have to comply, and we have this set of values, but we also want to go beyond those exclusions and say, well, what can be our impact as a pension fund? So what are the mechanisms that we can push to,
no one else can push.
Well, that no one else can push, exactly, ideally. So I think I really want to highlight the work that Abendrot does on the real estate. So 1/3 roughly is invested in mostly Swiss real estate. And they just are really good in often transforming older areas where there's already some building standing and sort of creating something new out of it. And they tend to be really beautiful places, nice architecture, but at the same time not too expensive. So sort of people can afford to live there. So I think as a real estate developer, you have a wide range of, really doing bad, to the wider economy and the sort of also the locality where you're active, or doing something really good, right? It makes a big difference. So I think there we have a big impact. And then more on the sort of the investments in stocks and bonds and so forth. We have this matrix where we say, well, we sort our investments into how good is the investment and how much positive influence can we have. And sort of ideally, we want good investments where we can have a lot of influence in making it even better. But we also, of course, we look at, the expected return and the liquidity of those investments in building this pension portfolio, right? So it's not the only consideration, but given that we think these are good investments, we sort of then try to optimize on these two fronts as well.
And if you compare Abendroth to other pension funds who don't have these initial values or these additional values to, let's say, more ethically and considerable and sustainable investments, does Abendroth are they doing better? Or are you guys doing better, or equal or not?
I think there's a strong difference, and you can see that. Just based on the holdings that we have, I was pointing out the real estate objects. You can look at these locations and see it for yourself. In comparison, for example, Publica is another and very large Swiss pension plan, and they also have a set of values, right? So they have taken the approach, and I think it's clever that they said, well, we are the pension fund of the Swiss government employees. So any law in Switzerland and also international treaties that Switzerland has signed is going to be a value for us that we follow. So for example, they say, well, the Paris Agreement, Switzerland has ratified it. So that's something for us to take on board as we make our decisions. But Abendroth is just emphasizes that just a lot more. So the values are stronger and more influential, I would say, in the decisions. You can say that there's a rating by the Klimaallianz every year, and we sort of usually come out on top. And I think it's for a reason.
But my question was also more directed in terms of return for the pension holders. Yeah. Are you doing better, or is there a psychological dividend that you basically have compared to other pension funds? It goes up and down, but then sort of, we've been doing really well recently. So at the moment, you could almost be tempted to argue, see, it actually pays off. I'm not going to do that because I don't believe that's true. I think we're doing a good job on, both fronts. We are, right? Because we pay attention on all these fronts, right? We don't say, this is, unattractive return, but it has impact, so let's go for it. We don't do that. We have, so let me say we look after costs, right? We have a strong equity portion, and we do engagement on all of those holdings. So I think that's one important point. We manage 2.5 billion, but we're still then a small fish compared to these huge corporations. But we do that because we think that's part of our responsibility to make our voice heard. And then we have a significant private equity tranche because we believe there in private equity markets, there's more friction than in public markets, and there sort of our decision and then delegated to the funds that we invest with, the decision on which companies they work with and where they invest is probably on balance a bit more relevant than in the public markets, right? Mm-hmm. Sort of this sort of capital allocation becomes more important. But even more so, because private equity markets are also competitive, I think even more so what's really important is the expertise that PE funds bring with them along in addition to the capital. And often, they'll take board seats. And so as a private equity investor, you have quite a bit of influence and, on the strategy and the direction that companies are taken. But they remain all very interested in the economics of the business, right? So they would never sort of say, let's do something where we all know this is not going to work out. But no, right? Sort of they
they try to just put their finger on the scale when you have these decisions. We could do it this way or that way. We're not quite sure which way is more profitable, but we know that one way is more ethical. So then, that's what we're trying to push through the investment value chain, that those decisions are then taken.
And there's in pension funds, there's also this, or I think generally investing is this principal agent problem to a certain extent.
Yeah.
I was wondering, because the investors have certain preferences,
yeah,
and Stiftung Abendrot has certain values, and obviously these values and preferences are not going to be completely different.
Yeah.
But how do you manage to kind of collect or captivate these preferences of the investors and factor them in in investment decisions that you take during a year?
That's a really good question. I mean, effectively, we have statutes and we have an investment policy, and we implement that investment policy on the behalf of the beneficiaries as best we can in trying to realize their preferences. But there's not an immediate we don't do a survey and asking, what would you do in this case? There is a pension fund in the Netherlands who they actually have done that. So they've done a survey, and it's very interesting. But we don't do that explicitly. But there is, of course, every year there's an event where beneficiaries can come and there's a conversation. So we try to be in touch, and also proactively. There's a newsletter where we explain what we're doing. But of course, not everyone has the same preferences or the same emphasis on those preferences. And that comes back to what I mentioned earlier, that in Switzerland, you could just have that as a market-based system that people could select into our pension plan, or leave if they don't like it. It's the employers who actually have to do that. And so there's a bit of stickiness and friction there. But that's just a peculiarity of the system here. But if people, of course, it's probably worth talking to your boss or to your CFO if you feel you're in the wrong pension plan. It's worth a conversation.
Well, what I'm certainly sure of is that this was a worth conversation. I think we learned a lot about both macro side, micro side of sustainable finance. Is there something that I forgot asking that that you always say that's really important for people to know about sustainable finance? Like kind of in German you would say Schlussplädoyer.
I see. So one thing I would like to add is that, if you're interested in that space, then it's often interesting, to concretely what are potential products. So I wanted to point out that with Abendrot, actually, you can go on the homepage and see the whole portfolio if you're interested. I'm quite proud of that's so transparent that it might be interesting for people who want to follow up on that. In terms of a Schlussplädoyer, I guess, my ambition in this, I'm interested in the impact angle. I think if you want to have impact, then the things that you should consider are trying to support startups that are doing something useful to the extent that you can bear the risk. Don't overdo it. Second, try to realize shareholder engagement, because we know it works, and it's a small contribution, but it is a contribution. And third, don't forget there's many other options beyond investing, including the political process, what you do with your own life, your consumption, and so forth.
Houses.
Your house, if you have one, right? Try to play all these cards, because the challenges we face are big. So we have to I think, pull all levers that we have. And I think the most important thing is that you pull a lever. So be sure to do that.
Wonderful. I'll leave it at that. Thank you for everyone for tuning in. Thank you, Julian, for joining and taking your time. appreciate that a lot. And yeah, with that, I wish you all a nice day, and don't forget to pull the lever.
Yeah, pull the lever. Thank you so much for having me. That was fun.